So, Michael, this looks pretty good.
Yeah, the personal consumption number, household spending, unambiguously strong. The data in the quarter was really pointing to that, so that's not a surprise. My guess is the rest of this report is going to be soft. So business spending is likely to be negative again, and we likely have major drags from net trade and inventories as well. So I think where headline GDP growth is about in line with what everybody expected. I think it's the composition of the data here that's worrying the Fed. Solid household consumption, yes, the expansion's likely to continue, but weak business spending correlates with the industrial slowdown.
Yeah, and fair point. I mean, spending on equipment, for example, falling 0.6% in the second quarter. So echoing what you're talking about, is 0.6% like in line, or is that worse?
It's a slightly better than we thought, but I mean, in the margin of error with what you'd expect, depending on where the revisions came in, that could be the third consecutive quarterly decline in equipment spending, and housing activity is probably down about 5 to 6 straight quarters now. So there's an indication that you have a manufacturing slowdown, but you also have an indication that monetary policy may be a little tight. And those two combinations, those two things are what are combining, we think, to cause the Fed to ease.
So just to illustrate what Michael's saying, we'll put up a chart. It's not updated yet for this quarter, but you'll see the trend that Michael was just referring to on the decrease in business spending. So Denise, when will this show up, if it will show up in the overall numbers, the decrease in business spending?
Yeah, the overall GDP numbers might not show in terms of the U.S. consumer really dominates in terms of the overall GDP number. And I think that that's what we were talking about in terms of the juxtaposition where business spending is quite weak, or investment spending, or however you'd like to measure it. Saw durable goods finally bounce back from a significant contraction over the last year. Global PMIs below 50 overall, with the juxtaposition that the U.S. consumer wage growth, income growth has been relatively strong. When I think from an investment perspective, you look at what your concerns are for the cycle. In the data I see, there is a fork in the road. A lot of the odds I see are very significantly strong odds for a market advance and strong returns in a non-recessionary scenario. When you think about recession, what I think about from a framework perspective is a shock to the U.S. consumer. So to the extent that this report shows that we're not seeing any shocks to the U.S. consumer, I think that's positive from the framework of we may very well see a prolonged economic cycle continue.